The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gentlemen. Thank you very much for joining our webinar for today on IFRS and IAS Marathon. I just wanted to share a few things with you, and that's why starting the webinar from this. First of all, thank you very much for all the feedback that all of you have been sending us. This is very, very encouraging and really, really encouraged and motivated to run more sessions like these for you. I think it goes without saying that feedback that you people have been sharing with us, it definitely is a source of encouragement, motivation for all of us, not just for ACCA, but for the members also. Mr. Abu Bakr, he's been, we are regularly conveying your feedback to him, and therefore it's a motivation for all of us. I just wanted to make a few announcements. A lot of you are sending us emails asking about your certificates, asking about your the handouts or the recordings. Let me very clearly explain everything to you. Number one, certificates for all previous sessions have now been issued. They were sent out yesterday to all the members, all the people who had participated live. Please remember, only those individuals who are attending these sessions live are being sent their certificates. Those who watch the recordings, they don't receive the certificates. However, they can claim non-verifiable units for having attended or having watched the recording. Right now, we are using our GoToWebinar channel, which you can access directly by going to www.gotostage.com. It's GOTOSTAGE, gotostage.com. And if you search ACCA or if you search IFRS trainings in there, it'll list all the videos that are available there. However, after every session or while sending out certificates to all of you, we do mention the links where the recordings have been placed, number one. And number two, the shared directories, the online directories where we are putting up all the handouts. So people who are watching the recording, and if they want to access the handouts, they can download it from that particular link. It's on Google Docs, so you can download it from there without having to go through the hassle of contacting someone at ACCA and then us having to email those documents to all of you individually, which becomes quite a bit of hassle. So they've all been uploaded on Google Docs, and the link is being shared with all of you. When we send out the emails with the certificates, it contains the links, so you can access it from there. We did receive some emails that you were unable to open up the recording. The response to that is that the recordings are very much there, they're accessible. However, your browser settings could be such that they may not be allowing that content to be played. So if you could look at your browser settings or try to open up these video recordings in another browser where the settings are different, that would probably solve the issue. So there are certain browser restrictions which sort of stop your browser to open up a document from Google Docs, for example. So if you can change that, fair enough. If not, use another browser and try to access the same resources. So thank you very much once again. I think I cannot reiterate the fact that your feedback, I cannot reiterate the fact enough that the feedback that you provide us is very, very valuable to us and is regularly conveyed back to the trainer. So for example, an ACCA member suggested to us that we should spend more time on disclosures, and that was immediately discussed with Abu Bakr Sahib, and he had already sort of received this feedback, and he has now incorporated more disclosure related information in the webinars. So thank you all very much. I'm sure we are continuing to add value to your professional development, to your ACCA membership. So continue to watch us on this channel. Thank you very much. I'm now handing over to our trainer, Mr. Muhammad Abu Bakr.
Thank you very much, Mr. Harun. Uh, Assalamu alaikum. Good evening, respected members. Uh, I would like to thank you at the start of this session for your valuable feedback. And today, our topic is IFRS 15. Can you people hear us? Please share your feedback. If you can hear me, please say yes. Okay. People are saying they can hear us. Okay. See, IFRS 15 is a complex standard introducing far more prescriptive requirements than were previously included in the IFRS that it replaces, like International Accounting Standard 18 revenue, International Accounting Standard 11 construction contracts, and a number of interpretation related to those standards. And therefore, it may result in substantial changes to revenue recognition policies for some entities, and it requires the application of significant judgment in some areas. But in other areas, it is relatively prescriptive, allowing little room for judgment. The main specific topics on which more prescriptive requirements have been introduced include the identification of a contract with customer, number one. Number two, the identification of distinct performance obligations and the allocation of the transaction price between those obligations. Then accounting for variable consideration and significant financing component. Recognition of revenue arising from licenses, and presentation and disclosure of revenue from contracts with customer and other balances related to revenue. Other changes include the scope of IFRS 15 has been expanded to cover costs relating to contracts. The recognition of interest revenue and dividend revenue are not within the scope of IFRS 15. These matters are now dealt with under IFRS 9 financial instruments, or for entities that have not yet adopted IFRS 9 IAS 39 financial instruments recognition and measurement. And specifically excluded from the scope of IFRS 15 are the non-monetary exchanges between entities in the same line of business to facilitate sales to customer or potential customers. This scope exclusion is different from the related guidance under ISA 18, which refers to exchange transactions that are not regarded as transactions that generate revenue. These are transactions in which goods or services are exchanged or swapped for goods or services which are of a similar nature and value. So this was a summary of some major changes in the standard. Okay, let's start with the standard. And in today's session, I will try to discuss the transition provision at length. Because this standard is applicable from 1st January 2018, so you need to apply those transition provision, because as compared to our last session on this same standard, standard setters has given some relaxation so far as the application of this standard is concerned. They have given some other approaches as well so far as the retrospective application is concerned. So we shall be discussing in a practical way, how can you apply this standard? What are the options available if you feel that retrospective application is difficult or complex, or you cannot apply for those, especially those contracts which are running from last couple of years, or maybe more than like 10 years or something like this, or any contract which started and ended mean somewhere in an year, which is appearing in the comparative information. So that's why how can you apply, what are the options available, what are the possible types of contracts which may need to be taken care of, we shall be discussing towards the end of this session. International Financial Reporting Standard. International Financial Reporting Standard replaces the following standards and interpretation. As I said earlier, International Accounting Standard 11, construction contracts; International Accounting Standard 18, revenue; interpretation 13, customer loyalty programs. Now, these loyalty programs will be dealt under this new standard. Interpretation 15, agreements for the construction of real estate; interpretation 18, transfer of assets from customers; and SAC 31, revenue barter transaction involving advertising services; and likewise IFRS 15 applies to all transactions with customers except leases within the scope of now IFRS 16, insurance contract within the scope of IFRS 4, in fact, financial instrument and other contractual rights, and obligations within the scope of all these standards, like IFRS 9, IFRS 10, IFRS 11, IAS 27, or IAS 28, non-monetary exchanges between entities in the same line of business. See, there are many aspects of these standards, like licenses, royalty programs, and each warranties, each of that requires a lengthy discussion, a detailed discussion before reaching to any conclusion. But what I did for this 3-hour session, I selected most of them, and I will try to cover them practically, so that this session should become a useful session for you people. Whatever we discuss, that should be, I will try to make it as clear as possible with the help of different examples taken from the standards, taken from the other sources, taken from my own firm sources, or from our own practical experiences. So I will try to make them as clear as possible. So I would request that your questions should be specific to the concept which is being discussed, because within this 3-hour session we cannot cover this standard 100%. So again, excuse me for not including the disclosures of this standard, because this standard has got extensive disclosure requirements. So if we include that, we cannot discuss. We will have to forego a number of important areas in this standard. So again, another thing is, this will be applicable from this date. Early application is permitted. Okay. Again, I would request members and other professionals who are sitting in group, please be quiet during the session, and they should not start commenting or discussion while session continues. And similarly, please have a notebook and pen ready in case you want to note something, or we may need to make small calculations. Then that notebook and pen will be helpful. And similarly, though it is a small session, I don't see that, I don't expect that you will feel I mean, you will become bored. But anyway, in order to avoid laziness or to make sure you remain attentive during the session, so it is better have some toffees or chocolates, of course, of your own, not of your neighbor. Okay. The core principle here is, this is the core principle, in fact. The entity shall recognize revenue when or as the entity satisfies a performance obligation by transferring promised goods or services to customer at an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods and services. The core principle is, in fact, the satisfaction of the performance obligation and the recognition of that amount which is expected to be received, in fact. These two things are important. So because this is the key principle within the standard, so this will keep coming back within the standard. Fundamentally, you should forget about the old requirements like matching revenue to cost, and potentially forget about strike lining as a default recognition method for some services. Because in ISA 18 provided recognition guideline for the recognition of services separately and guideline for the recognition of goods separately. But here in this new standard, same guideline will apply to the goods and the services. So there is no separate guideline. Similarly, as I mentioned earlier, a lot of interpretations are now superseded, and I mean, all their requirements are being covered by this new standard. Okay, in fact, this is termed as, in fact, 5-step model for the recognition of revenue. Standard has given 5 steps. Like if all steps are, you will be applying all these 5 steps before the recognition of revenue. Step 1, step 2, step 3, step 4, step 5. Step 1 will teach us, is there a contract? If we conclude after applying step number 1, there is no contract, so this means you need not to think about the rest of the steps. You cannot recognize revenue. If step number 1 holds, contract is there, then you will go for the step number 2. Then you will identify within that contract, is there a single performance obligation or multiple performance obligation? If there is a single performance obligation, fine. Step 2 provides us guideline about how can we identify whether the goods or services being supplied under that contract are distinct or not. Then step number 3, determination of the transaction price. If in step number 2 you concluded there is only one performance obligation, so mean step number 3 will become simple. Step number 3 will become simple. All the price will go to that single performance obligation. But if in step number 2 you determine that there are more than one performance obligation, then step number 3 is a little complex. Then you will have to segregate. Then you will have to allocate that transaction price to each of the performance obligations. Then step number 4. I explained step number 3 and 4 at the same time. In fact, I explained step number 3 and 4 at the same time. Step number 3 is simple. I mentioned step number 3, but in fact I was explaining step number 4. Step number 3 is simple. What is the transaction price? That is normally straightforward. Step number 4 is basically the allocation or the division of the total transaction price among the performance obligation which we have identified in step number 2. Then step number 5. Now, once we calculated the amount of transaction price to be allocated to each performance obligation, step number 5 will teach us like should we recognize that amount over the time or at a point in time. So these are the 5 steps which we will work through in turn. And we will cover additional areas as well. I will try to be as practical as possible. I have a couple of questions as well from some of respected members. So I will try to cover those questions during this session as well. But in case these are not covered, so they can ask those questions. But I have already, I'm going to open those questions in front of me, so that while discussing or discussing all these steps and the requirements of this new standard, I will try to cover those questions as well. So this is good. This practice is good. I appreciate, like Naeem Qureshi, this helps me in planning my discussion. So something which is like creating problem in your mind. So it is better if you could send it before the start of the session. So this helped me in planning the my session. Okay. Now let's move to step number 1. Step number 1 is basically you need to identify, is there a contract with the customer? So this is the first step. So what is the contract? So for contract, the parties to the contract must have approved the contract in writing, orally, or employed by customary business practices and are committed to perform their respective obligations. So the entity can identify each party rights regarding the goods or services to be transferred. Mean within that particular contract, these elements should be there. Number 1, that contract is approved by the party. Number 1. Number 2, the entity can identify the respective each party's rights regarding the goods or services to be transferred. The third one is the entity can identify the payment terms for goods or services to be transferred. Fourth one is the contract has commercial substance, that is the risk, timing or amount of the entity's future cash flows is expected to change as a result of the contract. And it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. See, in case of normal retail sales, you go to the local grocery store and there is no written contract between customer and shopkeeper, but there is an oral or implied contract in that transaction. So contract is there. Contract does not exist if both parties can cancel without penalty. For example, if a customer called you and told you that he will be ordering you like 1,000 units next month. Sorry. So this commitment is not enforceable in law. So that's why this purchase order can be cancelled without penalty. So in this case, this is not a contract. if I mean, any party can cancel it without penalty. Okay, I will. Rest of the points are quite obvious. I would like to. Draw your attention towards this last point: probable collection of consideration. This is very important. If all other contract terms are there, whatever mentioned on the top, all conditions are being met, but it is not probable at the time, at the date of the contract, that you will collect the money. So you cannot, this means this is not a contract. For example, an entity, I suppose I have this material. Yes, you people can see this material, please. You can see this material, lecture examples.
In the meantime, can we take questions?
No, after this, after step number 1.
Okay.
Can you please see this material which is appearing now on the screen? Please answer yes or no.
Yes.
Yes, okay, fine. See, through this example, we will learn two things. First, if an organization enters into a contract, but when you look at the overall scenario, position of the customer, circumstances, conditions, you conclude that at the date of the contract that it is not probable that you will receive the money. Standard says don't recognize revenue. You can keep on reassessing, and subsequently you may conclude that okay, now we can see that it is probable that we will receive the money. At that point in time, you can recognize the revenue. This is the principle which we will learn. What you will do, whatever you have received before that, small amount or a part of that amount, that will be recorded as a liability. Cash or bank debit, liability credit. I will be taking your question, but after certain steps, or even after the completion of first step, I myself will be telling you when you need to write down your question, so that concept could be discussed in continuity. I will revise again. We are discussing step number 1. Step number 1, you people know that there should be a contract. Only then this step holds. I mean, this step will be there. There should be a contract with the customer. I am discussing and assuming contract is approved by the party. Parties can identify their rights, respective rights. Parties can identify their payment terms, and it has got commercial substance. But it is you determined from the circumstances and from the other information which is available at the date of this contract that it is not probable. It is not probable that you will receive the money from the customer. Standard says don't recognize it as a revenue. Even if you have received a small amount or part of amount as an advance, but it is probable that you will not collect the money as a whole, so you should not recognize that revenue. Okay, let's see with the help of this example. An entity, a real estate developer, enters into a contract with a customer for the sale of a building for 1 million. The customer intends to open a restaurant in the building. The building is located in an area where new restaurants face high levels of competition, and the customer has little experience in restaurant industry. The customer pays a non-refundable deposit of 50,000 at inception of the contract. Note this, customer has already paid you people 50,000 rupees and enters into a long-term financing agreement with the entity for remaining 95% of the promised consideration. The financing arrangement is provided on a non-recourse basis, which means that if the customer defaults, the entity can repossess the building but cannot seek further compensation from the customer even if the collateral does not cover the full value of the amount owed. The entity's cost of the building is 600,000. The customer obtains control of the building at contract inception. In assessing whether the contract meets the criteria, the entity concludes that the criteria is not met because it is not probable that the entity will collect the consideration to which it is entitled in exchange for the transfer of the building. In reaching this conclusion, the entity observes that the customer's ability and intention to pay may be in doubt because of the following factors. Customer intends to repay loan which has a significant balance, primarily from income derived from the restaurant. It's restaurant business, which is a business facing significant risk because of high competition in the industry and the customer's limited experience. The customer lacks other income or assets that could be used to repay the loan, and the customer liability under the loan is limited because the loan is non-recourse. On this basis, you concluded that it is not probable. The last condition, the last condition is not being met. This last condition, this one, is not being met, so you will not recognize 1 million as our revenue. Okay, what about 50,000 which you have received in advance? For that, the principle is you will only recognize this 50,000 as revenue if any of these two conditions meet. Number one is the entity has no remaining obligation and substantially all of the consideration has been received and is not refundable. In this case, this condition is not being met. This condition is not relevant because the consideration has substantially all the consideration has not been received. Okay, let's see the other condition. Any of these two conditions. If contract has been terminated and the consideration received is non-refundable. Consideration received is non-refundable, but the contract has not been terminated. This means neither one nor two this transaction is not meeting either of these two. So the consideration, this 50,000, will be treated as a liability. Liability credit, cash debit. And even customer keeps on paying money, you will keep on increasing this liability till the time that it is probable that you will receive the consideration. Okay, now we can take a question from members. Yes, if you people have any question related to step number 1, please feel free to ask. And if we already have any question related to step number 1, Mr. Khayyam, please.
Okay,
state those questions.
One of our member is asking to please differentiate between step number 3 and step number 4. How can we specify?
Of course, we shall be discussing inshallah once we have been through step number 3 and 4. So I hope it will be answered, but otherwise you can ask this question again.
Is IFRS related to insurance contract as well? Asked by Sayyid Rehan.
No. This is not related to insurance contracts.
Okay, Naveed Ahmad asking with reference to rental contract for property, what would be the treatment of revenue if we know that tenant has run away? Do we still keep on recognizing the revenue, or we shall stop it at the date when tenant had actually ran away?
See, when he ran away, so at that time, from that time, it is not probable that you will receive anything. So how can you cannot recognize revenue? Next.
But Naveed Ahmad again asking that keeping in mind that tenant has not vacated actually and handed over the property back.
No, Naveed, see, the important thing is all steps and all requirements within each step should be fulfilled before the recognition of revenue. If running away mean like he disappeared without like settling his dues, or he will no longer be your tenant for the coming months. So if you have already recognized the revenue related to the completed months, so that will become the bad debt. And for the future, of course, you cannot recognize the revenue. Maybe I hope it should be clear, or otherwise you can specify your.
Does probable mean more than 50%?
Yes, probable mean more than 50%.
Okay.
Can you like on this AC, because it is becoming hot. Keep on asking.
The amount of 50,000 is non-refundable, but why can't we recognize it as a revenue?
Sorry?
The amount of 50,000 is non-refundable, but why can't we recognize it as a revenue, Mohammed Junaid?
Mohammed Junaid, see, this slide is in front of you. Either one or two should meet before recognizing the revenue. One is irrelevant because we have not received substantially all the consideration. And for two, there are two conditions. Consideration received is non-refundable. This is correct. This holds. But contract has not been terminated. So that's why you cannot recognize this 50,000 as a revenue. In two, there are further two conditions. So both conditions should hold before the recognition of the revenue. So this slide is important for you people. I mean, like while deciding should you recognize a part payment as a liability or as revenue. So this slide will help you in making that decision.
Adil Nasir, if example number 1 is in the scope of IFRS 16 or not?
Example number 1
is in the scope of IFRS 16 or not?
Example number 1 is basically a sale on deferred payment. So this is not the right of use. This is outside the scope of IFRS 16. Adil, I hope it should be clear. Next.
Kindly explain the rationale of crediting liability in case of non-refundable deposit. Mariam Alaudi.
Mariam, see, I have summarized these rules in front of you. Simply, Mariam, remember that like any of these two must satisfy before recognizing whatever amount you have received in advance as a revenue. If none of these two conditions hold, then you will be recognizing that amount as a liability.
Okay, can you please explain again point number 1 in step 1, Rabia Shams? Point number one in step one.
Point number one in step one, Rabia, entity has no remaining obligations. Mean you have fulfilled your obligations. Mean you have transferred the promised goods or services to the client and substantially you have received the money. And there are three conditions within number one, and those that money is non-refundable. If these three conditions are there, so you can recognize the money received as a revenue. Next.
How can we measure the reliability or probability to ensure that there is no overstatement in the revenue?
Who is this?
Fateh.
Fateh, see, as we have seen in example number one, you will analyze the whole situation, of course, of your customers, like you perform the credit rating, and all these methodologies will be applied before reaching any conclusion. Of course, individual circumstances of your customers play a major role in your decision. Like here we have seen, like they people will pay the amount from the revenue of this restaurant. Then they do not have experience of this restaurant. Further, they do not have other assets from which they can like repay your amount. So all these factors are indicating that it is not probable that you will receive the money. So you have to analyze. Subjectivity is involved. The approach is not very prescriptive. You have to apply your mind and analyze the situation. New standards require an accountant to be a little extrovert, to be out of his books and analyze the situation. Next.
If it is non-refundable, then what's the logic behind to recognize it as a liability?
Logic is we have to wait till the contract is terminated, because there are chances like if contract is not terminated, we are in fact deferring it. Like in prudent concept, like you do not recognize your revenue until you are very sure about that. You have a reasonable certainty, it is probable. So it is only a prudent concept. You keep it as a liability once the situation is clear. How situation can be cleared? Like project is terminated, and the money which you have received as per the contract, it is non-refundable. Now the situation is clear. Now you can recognize as a revenue. Otherwise, before that, it's a matter of you have taken precautionary measures. In fact, next.
Should the revenue be recognized if customer has utilized the building for 1 year and we receive part payment related to that? It means that we have provided them services.
Who is this?
Shiraz Qadir Baksh.
Shiraz, providing services. You mean you have fulfilled your obligation. Is not the decision factor. The decision factor, is it still probable that you will receive them? Okay, we can move further.
There are lots of questions.
Okay, can you please tilt its? Okay.
You can continue with the
Okay.
session.
Okay, we move to the step number 2. So a contract not meeting criteria, and you should constantly assess this contract to determine whether it subsequently meets the criteria. Okay, this was the step number 1. Now step number 2. Identification of the separate performance obligation. Why is identifying the performance obligation is important because it determines when and to what extent revenue is recognized. I repeat, why is identifying the performance obligation is important? Because it determines when and to what extent revenue is recognized. In a contract with a customer, there could be one performance obligation. Mean you need to supply, you have one promise, or there is a possibility that there are multiple promises for the supply of goods or services under a contract. In that case, within that contract, there will be more than one performance obligations. You will have to segregate. Okay, this is very critical. Step number one is easy. Don't bother about that. Simply remember slide number 2 where we have learned, like if you have received a part of money but certain things are not being fulfilled, and keep it just a liability. Once all those conditions are there, simply treat it as if step number 1 has step number 1 holds. Step 2 is very important. That is straightforward. Only you need to remember certain things. Step 2 is, in fact, you have to go through your details of your contract. You have to go through the details of your contract and need to ask 2 things to yourself. Number 1, is the good or service capable of being distinct? And is the good or service distinct in the context of the contract? No, this is a standard language. Of course, this is a little difficult. So I shall try to explain 1 and 2. How can you see, is the good or service capable of being distinct? Like in a contract, the services and the goods which will be supplied, which are promised in that contract, you need to ask these 2 questions. If the answer to these 2 questions is yes, then those goods and services are distinct, and there are they will be covered under separate performance obligations. What is performance obligation? Performance obligation is, in fact, promise to supply goods or services. In this step, we try to see how many promises are there, 1 or more. How can you see that? Okay, if the contract cover more than 1 goods or services, if there is a 1 good or service, that is not an issue. Step number 1 is easy, simply 1 performance obligation, 1 promise to supply that good or supply that service. But where you need to ask these 2 questions when there are apparently more than 1 promises to supply goods and services, or services and services, mean more than 1 promises. Here you need to determine whether all these promises are capable of being being treated as a separate performance obligation, or they will have to be treated as a 1 performance obligation. So this is the question here. Okay, how you can see this is the goods or the service is capable of being distinct. Number 1, if you can note, please note it. Is the good or service capable of being distinct? Okay, let me use one of our okay, I use this. Can you please? It's coming directly to me. For this, please. Thank you very much. See, okay. So number one question. Is the good or service is the good or service capable of being distinct? If they are distinct, this means this condition fulfills. How can we see that? Number one, uh, does the entity regularly sell that good or service separately? Normally, I should not say normally, I should say, can we buy that? Oh, where should be here.
Skip.
Skip. Okay. Can be bought separately? If that service or good can be bought separately. So this means that good or service is distinct, or if this holds, this means this condition is yes, or can function independently. This is in case of like good, can function independently. If that can function independently from other service or good, so this means this is again distinct. This is again distinct. Or you can see that one is already transferred. One good, okay, this is difficult, debate, but these two will be helpful. I'll be explaining it, the third one, with the help of like examples, otherwise we will stuck on that. Simply, if that good or service can be bought separately, or the supplier regularly or time to time sell that good or service separately, so this means that is distinct. That is a distinct good or service, or mean that is that service or good is not dependent on the other good or service mentioned, promised in the contract. Again, that good or service is distinct. Mean answer to this question is yes. Okay, now come to the second question. The second question is, as I mentioned earlier, answer to both questions should be yes. Only then that item will be distinct. Okay, is the good, number two is the good or service distinct in the context of the contract. In the context of the contract. Okay, so how can we see this? Simply see three things. Simply just try to determine three things. Like Number one, does this require significant integration? If yes, this means that service or good is not distinct. Significant integration with other goods and services. Or like, does this require significant customization or like modification, one and the same thing? Modification, again, if yes, this means again this product is not distinct. Or highly interdependent, highly interrelated or interdependent. Okay, we can discuss this with the help of examples. Okay, let's go to the example number 10. We have here example number 10. This is the example number 10. Okay, example number 10. Here I have handouts for sample number 10. Okay. In this case, an entity, a contractor, enters into a contract to build a hospital for a customer. The entity is responsible for the overall management of the project and identifies various goods and services. Let me open this in front of me as well, so that I should be comfortable so far as its reading is concerned. Okay. Overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of the equipment, and finishing. The promised goods and services are capable of being distinct. That is, the customer can benefit from the goods and the services either on their own or together with other readily available resources. Like if you look at it here, engineering, site clearance, I can use this. Sorry. Okay, let me use this. See, engineering, site clearance, foundation, procurement, construction, piping and wiring, installation of equipment, and finishing. Of course, all these are capable of being distinct. You can hire any other person for foundation. You can hire another person for procurement. Even you can ask this same organization to price it separately. So the first condition is being met. That is, the customer can benefit from the goods or services either on their own or together with other readily available resources. This is basically evidenced by the fact that the entity or the competitors of the entity regularly sells many of these goods and services separately to other customers. In addition, the customer could generate economic benefits from the individual goods and mean they regularly sells these services to the other customers. So this is the key point. So this means this condition, this number one condition is there, can be bought separately. All these services, which are in fact meant for the building of the hospital, can be bought separately. So this means first condition, all these services which are comprising, which are involved in the construction of the hospital are capable of being distinct because of the first reason. You can buy it from this same supplier separately. For piping, you can ask them for piping, you can ask them for engineering, you can ask them for the foundation, you can go for separately. So the first condition is being met. Now let's have a look at about the second condition. See, the second condition is, in fact, the second condition is not being met. Why? Because this is evidenced by the fact that entity provides a significant service of integrating the goods and services. The inputs into the hospital, the combined output for which the customer has contracted. Customer has not contracted for piping, foundation, engineering, construction, finishing. Customer has contracted for a combined output which is a hospital. So in this case, all these different products and services are in fact integrated with each other. Because they are integrated with each other, so this means they are not capable of being distinct in the context of the contract. So second condition is not being met. So this contract is a single performance obligation. So this contract is a single performance obligation. Because both criteria are not met, the goods and services are not distinct, the entity accounts for all the goods and services in the contract as a single performance obligation, which is the construction of the hospital. Okay, now let's move to the second example. Here, yes, second example. In this case, an entity, a software developer, enters into a contract with a customer to transfer a software license, perform an installation service, and provide unspecified software updates and technical support online and telephone for a 2-year period. The entity sells the license, installation service, and technical support separately. The installation service includes changing the web screen for each type of user. For example, marketing, inventory, management, and information technology. The installation service is routinely performed by other entities and does not significantly modify the software. The software remains functional without the updates and the technical support. See, now my question is, determine which goods and services are distinct in accordance with IFRS 15. The goods and services involved in this scenario, if I just increase its size to make it more visible. So here we can see that we have here software license, installation service, software updates, in technical support. Technical support. Software lessons. Okay. Okay, software lessons. I can mention here. Oh, it is moving. Anyway, software lessons. This is one. So there are four things, four services which we can see from here. Now the question is, which one of them capable of being distinct? So try to answer this, then we shall be discussing. Take 1 minute and try to answer this. Okay. I hope you have made you have made up your mind. See, the software is delivered before other goods and services and remains functional without the updates and the technical support. Thus, the entity concludes that the customer can benefit from each of the goods and services either on their own or together with the other goods and services that are readily available, and the criteria, number one criteria is being met. Number one criteria is met. Mean all these services are distinct. Now let's look at the second criteria in the context of the contract. See, the entity also consider factors for that and determines that the promise to transfer each good and service to the customer is separately identifiable from each of the other promises. Like installation service does not significantly modify or customize the software itself, and as such, the software and installation service are separate outputs promised by the entity instead of inputs used to produce a combined output. Like in case of hospital, all those goods and services were promised by the entity to produce a combined output. Here, it is not the case. These are the separate outputs. Like installation is separate, software is separate. Software can function without that installation. Significant installation integration is not involved. If you just go back to our here you can see that none of these exist. No need of significant integration, no need of significant customization, and service is installation is not dependent on software. Promise of delivery of software is independent. They can deliver software without providing installation service. Company can buy it later on, no problem. So that's why second condition is not met. Second condition meets. Why? Because none of these exist. So that's why all these four are separate. All these four are separate performance obligations. So our performance obligations will be number one will be software license, number two installation service, number three software updates, and number four technical support. Now let's look at case B. In case of case B, the promised goods and services are the same as in case A above, except that the contract specifies that as part of the installation service, the software is to be substantially customized to add significant new functionality to enable the software to interface with other customized software application used by the customer. The customized installation service can be provided by other entities. Determine which goods and services are distinct in accordance with IFRS 15. Please make up your mind, try to identify, try to apply those two conditions. Normally, first condition will not be a problem. Okay. Here, there will be three performance obligations. Customized installation, number one, customized installation which includes software license. This is number one. Number two, software updates. And number three, technical support. Okay. If we have any question, I can answer them now.
Okay, we have lots of questions over
Yes,
here.
please.
Let me get back to the first one.
Can you please ask?
Should we credit the liability of non-refundable advance in the example as a deferred income?
Which example?
He didn't mention any.
We have example 10, 11, and earlier we have
With regard to non-refundable payment received. Again, not mentioning any.
non-refundable payment received. What is his question? I get his point of view. What is his question? Main question.
Should we credit the liability of non-refundable advance in the example as a deferred income? I think from the
No, it is not a
first
deferred income. It is not a simply liability. Simply liability, because for deferred income, you must be knowing why it is a deferred income. Why you feel that it is deferred income.
Mariam Alauddin asks,
Deferred income. Yes.
kindly explain the rationale of crediting liability in case of non-refundable deposit, and kindly explain the rationale of crediting liability in case of non-refundable deposit 50,000. Apologies for the typo error.
Again, what is the question?
Kindly explain the rationale of crediting liability in case of non-refundable deposit.
Okay, Mariam, tell me one question. You have received the money from a customer. Very simple. And that is in fact a part of the revenue. But when you want to recognize it as a revenue and try to apply the criteria given in new standard, you realized that you cannot recognize it as a revenue. So what you will do with that money? Of course, liability. Cash debit, liability credit. Once either contract is terminated, this is already non-refundable, contract is terminated, then you can transfer this amount from liability to revenue. Mayam, I hope it should be clear.
Adil Nasir, in the point number 2, when contract has been terminated, how we recognize revenue?
Simply liability debit, revenue credit.
Okay, if there is no termination clause in the contract or silent, then contract will exist or not? Muhammad Ishaq.
Muhammad Ishaq, if contract is silent, I mean nothing is mentioned, then we will have to look at the specific situation of the transaction. So that specific situation can vary from one contract to other contract. That will help us in deciding the course of action.
Okay. If the customer does not pay further amount and quits, then we will consider 50,000 as income.
Yes.
Completion one.
Yes, complete income. You will debit liability and revenue credit. Next.
Rashid Hanif, dear sir, also conduct some webinar on international standards on auditing, please.
Just before the start of this session, Mr. Harun was discussing this point with me. So hopefully we will be inshallah conducting, especially on CAMs, key audit matters, because practically I have seen even within my firm and there is a need. We are already developing a lot of material for usage within our firm, and that is being provided from our head office. But I feel that because there are a large number of firms which do not have such resources, so I think these are important and we shall be considering it. We have already started thinking on these lines. So we should address those areas. But I would request CAM is one area. If all of you people can highlight those areas where you need sessions to be conducted, so that will be very helpful. Because normally audit is considered to be an easy part. Of course, a lot of material is very easy, but still there are areas, especially for those people who are working at a supervisor and managerial director and partner level. There, of course, they are they need to apply certain standards which are really need to be explained, need to be discussed from time to time. So I would request all of you to email to Mr. Harun or to me as well, if you think it is appropriate, those areas where you feel that we should conduct these sessions. Next.
If tenant disappeared and unable to collect remaining considerations, so will there be impact on irrecoverables? Usman.
This is of course bad debt. Next.
Okay, if client has given PDC checks against the contract, but we have, I think, post-dated checks.
Post-dated checks.
Against the contract, but we have not received the money at year end. Even post-dated checks are already due or expired. Should we still recognize the revenue? In UAE, if we have checks, we always assume that inflow is always probable, either through client or through court if we have legal courts.
You are right. If it is possible, like here in Pakistan, if you, I mean, this will vary from country to country, because even if you have post-dated check these days here in Pakistan, and there is no guarantee that you will receive this money. So that's why this will vary from country. It is a question of basically law enforcement. If you feel that your law enforcement agencies are working well and you will be able to recover that money, of course you can recognize your revenue. No problem. Next.
I think pay orders are alternative to post-dated checks.
No, they are not in fact alternative. They are basically money in your hand.
Yes.
Actually, here previously, this was being enforced very strictly, but recently, from a couple of years, government is lenient and law enforcing agencies are a little lenient. But practically, we have found. I am not commenting on any particular government, but practically, we have found that these post-dated checks are not very helpful here in Pakistan. So you cannot recognize revenue here in Pakistan. Next.
If consideration is non-refundable, then why we are recognizing it as liability? No, we don't have to pay it.
Shiraz, as I explained earlier to Mariam as well. Shiraz, please listen me carefully. You enter into a contract with a customer, and customer paid you like $100 as advance. Now you want to, the question is, because you will be debiting the cash. Now the question is, should I credit revenue? The answer of this question will be like coming from this new standard. And this new standard says, if it is not probable that you will receive the consideration, you should not recognize the revenue. This means revenue cannot be credited. So what should be the credit? Liability will be credited. Shiraz, I hope this is quite logical. I explained it earlier. Even you can listen to it again in recording, please.
If an entity enters into a contract with a potential to supply goods in a bulk quantity, but there is an ambiguity for entity to determine that in how much time the customer will pay for goods dispatched, in fact. Should we recognize this transaction as revenue?
Who is this gentleman?
Burhanuddin.
Burhanuddin, we shall be recognizing it, but the question will arise, how can we determine the transaction price in fact? That will be recognized as a revenue. That will be addressed in step number 3. Next.
Can you please explain in slide number 12, if contract criteria is not met in the first place, how can contract be terminated in condition 2 when no contract existed in first place?
Ifsa, can you repeat his question, what she said?
Okay, can you please explain in slide number 12?
Yes.
If contract criteria is not met in the first place, how can contract be terminated in condition 2?
Okay.
When no contract existed in first place?
See, when you enter into a contract will be there in the meaning of the contract. Now the question is, does this contract fulfill the criteria to be identified as a contract under this new standard? This is the issue. Contract will be there. The question is, can we treat it as a contract with the customer under new standard? If all conditions are not there, you cannot treat it as a contract under this new standard. But contract is there. If it is terminated, whatever amount you have received, you will recognize it as revenue. I hope it is clear, because contract means between two parties. There are certain things written down, there are certain clauses there. Now, does this contract qualify to be treated as a contract under this new standard? This is another consideration. I hope it should be clear. This is a very technical small point. I hope it should be clear.
At the inception of the contract, the performance obligation on the side of the supplier is fulfilled as the possession of the building is transferred to the customer. Yes. Then why we did not recognize the non-refundable advance payment as a revenue, assuming step 1 is completely met?
If step 1 is completely met, this means step 1 involves, if we just look at this slide, step 1 involves probable collection of consideration. If this condition meets, then you can recognize that. But if you just look at that particular scenario, this condition is not met. Contract is there, but as per 15, that contract is not identified because the last condition is not being met. I hope it should be clear. Next.
If the company sells scratch card to distributors who eventually sell it to the customers, but not sure when the sale will be made, when we should recognize revenue?
See, that amount will be recognized as a deferred revenue. And so far as the credit cards, scratch cards, I suppose these scratch cards related to the mobile services. So whenever they use the mobile services, because the intelligence network of any mobile company provides them the data about the usage of those scratch cards at the end of each reporting period or whenever they require. So based on that usage, you can transfer the amount from deferred revenue to the revenue based on that report. Next.
In the case of export sales, how can both parties approve the contract in written due to the distance?
No.
Approximately, these answer.
See, in export, it is not like, distance is not an issue these days. You can send your contract, you can do your contract by digital signature. All these services are available. Even in the third world countries. In 2016, I made a contract with IASB. You people, some of you may remember that. I authored a big book on application IFRS application guide. I made a contract with IASB, and both parties signed that contract electronically. So all these things are there. This is not the question. Yes.
Say for example, we have a consideration of $1 million. When we say substantially, does it mean full $1 million or it can be 6 lakh?
Substantially mean like 7, 8, this is
More than
judgmental, more than 50%, but it is better more than like 60 or 60, but this is my personal point of view. For sure, more than 50%, for sure. Next.
Could you explain contract terminated in second condition?
Usman, what is your exact question? How should what is the angle that should be explained?
Okay, until the time he writes us with particular theory, we will be having another question. Particularly not in all cases, all the info is available. So how to deal in that case?
See, ask question. I am expecting that you should ask question about step number 2. That is important.
Mohammed Wasif, again, information about business, customers, other assets. Okay, we will be having another question. Once we have received non-refundable income, we can recognize because we are not going to return. Is the assessment of probability judgmental and depends largely on the management?
Judgmental, of course, judgmental.
Okay, when you read the question, please raise your voice. All 4 of them are distinct. Yes, the goods and services are distinct. Okay, installation. Please elaborate more on the criteria of customer benefits, either their own or with other readily available goods or services.
Who is this gentleman?
Azizur Rahman.
Azizur Rahman, this is being used for this question.
We don't have any name with this person because some people can also attend offline.
Okay. Benefit mean like you have a software, you can use it, and it is not like you can have separately installation services. You can benefit from it without obtaining this installation service from that particular supplier, or you can have it and subsequently you can go for the installation service and can benefit from this software. Next.
If there is partial delivery of goods in 2 different tax reporting periods, should we book the revenue in each month or combine it in the last month? It's country with the VAT regime. Goods are apparels that are distinct. Azizur Rahman.
Azizur Rahman, can you repeat your question? I suppose this is...
If there is partial delivery of goods in 2 different tax reporting periods.
Okay.
Should we book the revenue in each month or combine it in the last month? It is country with VAT regime.
Azizur Rahman, see, this is not the question related to any step. This is basically, in fact, your basic accounting principle. Whatever you supplied in a particular year, that will be recognized in that particular year. And the remaining supply will be recognized as a revenue in the next year when you supplied it, in fact. I mean, this is nothing to do with step number 1 and step number 2. Next.
Can you please explain fund management services? Will it be distinct or not?
See, fund management services. Fund management services. I mean, what is your exact question? In fact, there should be more than one.
Will it be distinct or not?
Fund management, of course, distinct, but it depends on the whole situation. Within that situation, we can see that what other services are being provided, and then applying this criteria. So then we can decide whether all these services will be taken as one or these are distinct. I mean, from this one line, I cannot answer this question.
Can we recognize revenue if we have undated security checks covering the outstanding amount from the customer against the contract?
Again, this depends upon the country. If you are in a country where these checks will be honored anyway, either by the customer or through the court, then you can, otherwise not.
In case B, I suppose the customized installation that modifies the software is not a distinct service.
You are right.
Kindly tell me whether I am right.
You are right.
Okay, same with
actually you are on those questions which were asked maybe 20 minutes before. Anyway, you are asking those questions in a row, isn't it?
Yes.
I mean, you are trying not to ignore any of the question. Okay, fine, no problem. Can you give me this?
In case P goods and services are distinct, it would be appreciated if you conduct webinars on ISAs regarding client acceptance procedures. Thanks.
Client acceptance procedure. Okay, well noted, but it is better because this is in the comment. It is better send an email, small email, one line to Mr. Haroon and to me as well if you want. So this is noted. This is well because this is very important area. This is again related to your senior people because they are there to decide should they accept that client or not, and there are multiple requirements like ISAs, law, and many other requirements. Next.
Will examples be shared or not? Zohar?
Definitely, Zohar, definitely along with their answers, they will be shared.
Okay. What about one-off projects, Zishan?
One-off project, Zishan, that will be a one performance obligation. Simple. Next.
When contract will be seen terminated in condition 2 for advance recognized revenue? When contract will be seen terminated in condition 2?
As per the contract will dictate when the contract will be terminated.
Actually, he is confused, I think, about advance recognized income. When we are already recognizing income, then contract, how can contract be seen as terminated in condition 2?
No, he need to clarify his question. Next.
Okay, what is the definition of distinct goods or services? Tehmeena Akhtar.
Tehmeena, definition, we are talking about the application, in fact. If the answer to these questions is yes, then those goods and services are distinct. Or if you want to go into further detail, then if the customer can benefit from the goods or service either on its own or together with other resources that are readily available to the customer. So this means that good or service is distinct, and if there is no significant integration, no significant customization, modification, no interdependence on other good, then that good is distinct. Tahmina, I suppose it is clear. Next.
No more questions.
Okay. Okay, we can go further. We have here warranties. Warranties are very important. Like here, normally we need to remember about warranties related to the step number 2, that customer has the option to buy them separately from the product to which it relates. Then that warranty is a separate performance obligation. Like you buy a machine and there is a warranty attached to it. If you can separately buy it if you want, and if you don't want, you can leave it, then this warranty will be treated as a separate performance obligation. Good, that machine is one performance obligation. This warranty is another performance obligation. Second, a warranty which provides a service in addition to the assurance that the product complies with the agreed upon specifications. Again, this warranty will be treated as a separate performance obligation. Other than these two types, any warranty will be treated under International Accounting Standard 37. Okay. Let me explain with the help of an example, because this is important point. This is applicable to most of you, because most of you, maybe a lot of people working in an organization which is providing warranties on their items. So this is very important point. Sorry. See, number one, like you bought a machine plus its warranty for 5 years, say. Or you have the option to buy the machine on, and later on you can go for the warranty. So in this case, where warranties can be bought separately, so here what will be its effect? Here, transaction price, the amount which you have paid for one above, will be divided into machine number one, machine A and B. Warranty mean there are two performance obligations. Mean if you have received like if you have paid like if you have received like 1 million, so you will segregate this 1 million, how much relate to the warranty and how much relate to that machine. Warranty revenue related to warranty will be recognized separately, and for machine separately. If this is not the case, you have received 1 million. In fact, if this is not the case, then like warranty cannot be taken out separately, because it is required by law. So why people should go for a separate warranty? Because it is already being covered by the law. So then 1 million, then there will be a one performance obligation, that is machine. and the whole amount of 1 million will be allocated to the machine. So far as the warranty part is concerned, you will be applying International Accounting Standard 37. You will be applying International Accounting Standard 37. Okay. Let's look at the example. Okay. Example is a luggage manufacturer provides all customer with a lifetime warranty that covers all defects and damages, including those arising from normal wear and tear. Okay. In this case, the service type warranty will be a separate performance obligation. The amount which you have paid for that luggage will be divided. The company will divide that transaction price and allocate them between luggage and the service type warranty. So this is related to the warranty. But if warranty is not a performance obligation, why? Because company is required by law to provide to cover whatever damages subsequently happen to that good to the customer. This is the legal right of the customer. Then that warranty will be treated under International Accounting Standard 37. Like here in this example, a washing machine sells for $500 with a 1-year warranty. The dealer knows from experience that 15% of these machines develop a fault in the first year and that the average cost of repair is $100. He sells 200 machines. How does he account for this sale? He will recognize revenue of 100,000. Mean all amount will go to the washing machine, because here is one performance obligation. The associated provision will be recognized under International Accounting Standard 37. Okay, because a separate warranty is not being provided. So this is all about warranties. Now, step number 3. Step number 3 is determination of the transaction price. Okay, before moving to the step number 3, I just want to highlight one point from step number 2, which is this. If there are series of distinct services that are substantially the same, have the same pattern of transfer, the customer, that contract can be treated if you want. I mean, they are distinct. If you want, you can distinct them. You can treat them separately, but you can, if you want, you can treat them as a single performance obligation. So the example is an entity enters into a contract with a customer to provide a weekly service to clean a customer's offices for 1 year. The contract is signed on 1st January 20X1 and the work begins immediately. The entity concludes that the service is a single performance obligation because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer. I again read it. An entity enters into a contract with a customer to provide a weekly service to clean a customer's offices for 1 year. Each week is distinct. The contract is signed on 1st January 20x1 and work begins immediately. The entity concludes that the service is a single performance obligation because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer. In that case, standard allows you to treat those distinct goods and services which are substantially the same, have the same pattern of transfer as a single performance obligation. Okay, now move to the step number 3. Step number 3 is again very important because in step number 3, we learn how can we determine the transaction price. Before discussing the transaction price, we can have a asr prayer break. Okay, ji, welcome back. Determine the transaction price. Here, this area is important. I mean, the amount of the consideration that an entity expects to be entitled to, and that could be different from your amount given on your invoice, and excludes amounts collected on behalf of a third party, for example, government taxes. That is, I mean, an obvious point, like sale tax is not an income, in fact, or VAT is not an income. You are just collecting, like $100 is your invoice value, and you charge like $5 VAT. So 104 is the cash, but in fact, $5 is not your income. Your income is $100. That is quite obvious. That is, in fact, you are collecting that $5 on behalf of the government. Okay, so in transaction price, we might include variable or contingent consideration, estimated as either the expected value or the most likely amount, to the extent that it is highly probable that a subsequent change in the estimated variable consideration will not result in a significant revenue reversal. I mean, you can only recognize variable or contingent consideration if this condition holds, that there are more than 50% chances that significant reversal will not take place. Small reversal, no problem, but significant reversal would not take place. See, example of variable consideration include discounts, rebates, refunds, price concessions, credits, and penalties. Depending on which method better predicts the amount to which it will be entitled, measure variable consideration by using either the expected value or the most likely amount. Most likely amount will be used when there is only two possible outcomes. So you can use the most likely outcome. For example, an entity either achieve a performance bonus or notes or not. So in this example, there are two possible outcomes. So you can use the most likely outcome, the most likely amount. Expected value is basically the sum of the probability weighted amounts in a range of possible consideration amounts. Maybe an appropriate estimate of the amount of variable consideration for a large number of contracts with similar characteristics. Okay, let's discuss the penalties with the help of example. Example we have here, example number 3, I suppose. Example number 3. See, an entity enters into a contract with a customer to build an asset for $1 million. In addition, the terms of the contract include a penalty of $100,000 if the construction is not completed within 3 months of a date specified in the contract. The entity concludes that the consideration promised in the contract includes a fixed amount of $900,000 and a variable amount of $100,000 arising from the penalty. So if it is probable, 900,000 you will be receiving, but 100,000 is contingent consideration. You can include this 100,000 in the total consideration if it is probable that significant reversal will not take place. So here you can include. The entity concludes that the consideration includes a fixed amount and a variable amount of arising from the penalty. Okay. Now, Next example is this was the example of variable or contingent consideration. Then there could be non-cash consideration. In case of non-cash consideration, you will be including that non-cash consideration in the transaction price. For example, an entity enters into a contract with a customer to provide a weekly service to clean offices for 1 year. This is the same example we started earlier, but I stopped where where I do not need the information further to explain the concept at that point in time. But now I'll be reading it in full. An entity enters into a contract with a customer to provide a weekly service to clean offices for 1 year. The contract is signed on 1st January 2021 and work begins immediately. In exchange for the service, the customer promises 100 shares of its common stock per week of service, a total of 5,200 shares. For the contract, the terms in the contract require that the shares must be paid upon the successful completion of each week of service. The entity measures its progress towards complete satisfaction of the performance obligation as each week of service is complete. To determine the transaction price, in this case, mean the amount of revenue to be recognized, the entity measures the fair value of the 100 shares that are received upon completion of each weekly service. The entity does not reflect any subsequent changes in the fair value of the shares received or receivable in revenue. So here, entity will be receiving 100 shares. So once a week is over, entity is entitled for those 100 shares. Entity will calculate the fair value of those 100 shares and record the revenue. Any subsequent change to the fair value of those shares will not affect already recognized revenue. So this is the non-cash consideration. Consideration payable to customers. Consideration payable to customers. Example 5 related to this, that will also be this will be deducted. This will be deducted from the revenue amount. Okay, we understand it with the help of example 5. So here is an example 5. An entity that manufactures consumer goods enters into a 1-year contract to sell goods to a customer that is a large global chain of retail stores. The customer commits to buy at least $15 million of products during the year. The contract also requires the entity to make a non-refundable payment of $1.5 million to the customer at the inception of the contract. The $1.5 million payment will compensate the customer for the changes it needs to make to its shelving to accommodate the entity's products. The entity concludes that the payment to the customer is not an exchange for a distinct good or service that transfers to the entity. This is because the entity does not obtain control of any rights to the customer shelves. Because for an asset, control is must. So control will remain with the customer. So that's why that is not a separate or distinct good or service. Consequently, the entity determines that in accordance with IFRS 15, the 1.5 million payment is a reduction of the transaction price. For example, after some time, you issue an invoice of say 2 million. What you will be doing, you will be reducing, when you will be recognizing, okay, you can create receivable 2 million, but credit will be revenue, you will be reducing it by 10 million, 10% of this amount, because you will have to repay to your customer 1.5 million, which is 10% of the 15 million of the total contract value. So when you will be raising an invoice of 2 million, so you will be recording a revenue of 2 million minus 10% of 2 million. Mean you will be recording revenue of 1.8 million and 0.2 million for that money which you need to pay for the shelves. So you will reduce your revenue with this amount. Okay. Then time value of money concept. Time value of money concept, again, if payments are deferred, there, like if you will be receiving money after some time, then there is a financing element. Like if you sell goods to a customer and the customer will be paying after 36 months or 48 months or 24 months, so then there may be a financing element. So how can you evaluate, is there any financing element, significant financing element? So if there is a difference between the cash price and the promised consideration, if there is a difference between the cash price of that good or service and the promised consideration, this is an indication that because of delayed payment, because of time involved in the transaction and the money which will be received, so there is a financing element. So standard requires you to separately recognize that financing element. Don't include that financing element in the cost of the like in the transaction price. For example, an entity.
So wait, we will be having some internet connectivity issue right now.
म्यूट कर दिया
You have to mute. I think broadcast.
अच्छा इधर भी सीन अभी तो उस पे चल रहा है काम, कोई मसला तो नहीं आ रहा है उस पे? शाबाश, बड़ा काम देके क्या से नसीब में। वो तेरी खैर नहीं तो वो हुई स्कैन नहीं हुई। अच्छा चलो करो फिर मैं
We are connecting.
हाँ बस थोड़ी देर तक मैं सेशन खत्म करने लगा, वो रिव्यू करूंगा। मुझे दूसरा बताओ कि यासिर इकबाल की क्या सोच है? Okay, there is a disconnection due to internet problem, and so I shall be resuming. I will try to resume from the point where we stopped. Okay, can we talk now?
Yes, if you can find out from them, they can hear you.
Yes.
Okay. Question. Okay, we were discussing.
So, पहले पूछ रहे हैं, they can hear.
Can you people hear me? Am I reaching you? Please tell yes or no. Can you people hear me?
Not listening properly.
Uh, can you people hear me?
I cannot.
Please answer yes or no.
Voice is not reaching. Yes, people are saying yes, they can hear.
Okay.
Sound is
Sorry for
fine.
the disruption.
Okay, sorry for the disruption, and I will try to start from the same point where we ended, where we broke. Uh, Time value of money. See, if money will be received after a significant amount of time, then you will have to consider the time value of money as well. For example, an entity sells a product to its customer for $121 that is payable 24 months after delivery. The customer obtains control of the product at contract inception. The cash selling price of the product is $100. The entity's cost of the product is $80. This contract includes a significant financing component, and this is evident from the difference between the amount of promised consideration, that is $121, and the cash selling price of $100 at the date of the goods are transferred to the customer. I will repeat, the indication that there is a significant financing component is that if there is a difference between the promised consideration and the cash price of that good or service. So this means there is a significant financing component. In this situation, the entity will not recognize the revenue at 121. Instead, the revenue will be recognized at $100. I mean, if I use the word here just to explain it, see, cash selling price of the product is $100. This is the cash selling price. Selling price. But your customer will be paying, you invoiced him for $121, and the payment will be received after 24 months. The payment will be received after 24 months. So the difference between the cash price and the consideration agreed is an indication that there is a significant financing component. Standard says the transaction price of this good will be, or the amount with which the revenue will be recognized is 100. Your entry will be debit receivable. Okay, let me come down. Entry will be debit receivable. Debit receivable with 100 and credit revenue with 100. Credit revenue with 100. And subsequently, you will unwind this receivable. but revenue will remain unchanged. So this means if time value of money is involved, recognize your revenue equal to the cash price of that particular item. Okay. Now, I received one question this morning from Mr. Naim Qureshi related to this area. So I would like to answer that question because we are discussing the relevant area. As I said, transaction price will include the variable or contingent rent. His question was, as per company A policy, client B is eligible for 3%, 5% and 7% rebate for achieving certain targets such as 3% if sales achieved Saudi Riyal 0.5 million, 5% if sales achieved Saudi Riyal 0.7 million, 7% if sales achieved Saudi Riyal 1 million. Note, rebate available in the form of quantity only and the time period is 12 months for this target, 1st January 2017 till 1 year. See here what you will do when you started selling goods to this client. So you will estimate that by the year end, what will be the amount of rebate given to that customer. If you estimate that, like by the year end, customer will not buy goods worth 500,000, then of course you will not consider any discount in the calculation of the transaction price. But if you estimate that, okay, keeping in view whatever information related to your client is available, you estimate that, because there could be many situations, but I am taking one situation. If you estimate that no, he will very easily achieve 0.5 million, on which you have offered him to give 3% rebate. So you will be recognizing revenue by deducting this 3%. You will not be recognizing revenue as a 500,000. You will reduce that 500,000 with this 3% rebate. If during that year, if that customer actually reaches to 700,000, which is another benchmark, which is the level where you will be providing 5% discount, there what you will be doing, you will be providing 7% discount on the cumulative figure, and the revenue will be adjusted with this 7%. For example, on 5% rebate was 15,000 as per 3%. So this means you recognized initially the revenue 485,000 receivable debit and revenue credit 485,000. Assume subsequently he achieves the level of 700,000 where you promised him to provide the discount of 7%. There you will again be calculating what is the rebate. 7% of 700,000 is, no, sorry, 5%. 5% is the discount on 700,000. So this gives you 35,000. 35,000, out of 35,000, 15,000 is already recognized. So only 20,000 need to be recognized. What you will do, you will pass an entry revenue credit 180,000 because the additional revenue after 500,000 is 200,000. So 20,000, 180,000 revenue credit, and your like receivable debit with 180,000. So in total, this 180,000 plus 485,000, this will give you the total revenue for that. And likewise, I mean, this will be applied on a cumulative basis. Your revenue will be reduced on a cumulative basis. It is not like this that you have already recognized a 3% revenue, 500,000, and on that you deducted the revenue by 3%, and subsequently he reaches to another level where he is entitled to a higher level of rebate. You will be affecting the already recognized revenue as well. So this is the answer of your first question. Then you have asked about the gift vouchers. See, what I understood from your given information, like gift vouchers are such, like you can buy a gift voucher from a superstore and you can gift it to any person to whom you want, and that person can utilize that gift voucher, and that gift voucher can be denominated in 50 real, 100 real, 200 real, 500 real. I mean, you are giving to another person that gift voucher and you bought it from the supermarket. So when you sell, you have mentioned here company A selling its core business products and also selling gift vouchers only without having value of Saudi Riyal, 50, 100, 150, etc., which buyer can use at any other superstore retail chain later on. How company will make accounting entries for tax invoice purpose when selling gift vouchers only, and when voucher actually used by the buyer at other store. See, this situation is independent of the VAT. Even for VAT people, like if you are receiving a money from a client and you have not yet supplied the goods or the services, that is your advance. So these gift vouchers, when you will be selling it, you will not be recognizing it as a revenue. When revenue is not recognized, the question of VAT does not arise. Subsequently, when these gift voucher will be utilized, will be used, then you can recognize the revenue and accordingly the VAT. But my comment about VAT is purely general, because how VAT will be affected, at what point your tax authorities treat a transaction as a revenue, that will vary from country to country. I am only answering this area of gift vouchers with reference to the IFRS 15. When you sell these gift vouchers, these are basically advance money which you have received. When any person utilize those gift vouchers by buying the goods or the services equal to the amount of that gift voucher, only then the company will recognize that revenue by debiting the liability and crediting the revenue. I hope Mr. Naim Qureshi, your point is clear. Okay. Now let's move to the, can you hand over me this mouse? Thank you. Okay, step number 4. Step number 4 is allocation of the transaction price. Is there any problem with the camera?
I am sharing from the other side.
Okay, fine. Okay.
People are seeing you.
Okay, based on the relative stand-alone selling price of the goods or services promised and is paid at the inception of the contract and not adjusted subsequently. Like in step number 2, if we conclude that our contract is for 2 performance obligation, one good, other service, or one is software license, other is installation. If these are the two performance obligation in our contract, we shall divide the transaction price agreed under that contract between these two performance obligations based on their stand-alone selling price. But stand-alone selling price could be observable price. See, having estimated the total consideration we are going to receive under the contract, we need to allocate that transaction price to each of the identified performance obligation, and we do that on the basis of the relative standalone selling prices of each of the distinct goods or services identified in the contract. This step is really only an issue when the contract involved group of services. Much contract normally involve multiple goods followed by related services or multiple services. The transaction price must be allocated to each of the separate performance obligation so that the revenue is recorded at the right time and in the right amount. Now the best approach is the standalone price that the entity charge for that good or service when it sells separately in similar circumstances to similar customers. However, goods or services may not always be sold separately. If that the case and the supplier does not actually have standalone selling price, the net selling price need to be estimated derived by other means, which obviously going to involve quite a bit judgment. There are methods you can use to allocate or estimate standalone selling price, and those include an adjusted market price. So looking at a competitive pricing and adjusting it appropriately. There is a usual approach which can be used in some particular circumstances. The important point to note is there is no such thing as like free lunch. Once we identified individual performance obligation, the total transaction price must be allocated to all of those obligations. We cannot apply all the consideration to any particular one performance obligation. For example, on January, you entered into a contract with a mobile phone service provider like Varid Telecom, and you receive a free handset on 1st January 2015, and you pay 2,000 per month. This includes hundreds of free minutes you are billed on the last day of each month. You can buy the same phone set from Varid Telecom for 500,000 without the payment plan. And you may also enter into a payment plan without the handset, in which case you will have to pay 1,750 per month. Mean you will be paying for 1 year 2,000, and you will be given a free set plus hundreds of minutes each month for 1 year, and you will have to pay 2,000. But if you do not accept that free handset, your monthly rental will become 1,750, and that set can be Varid Telecom will sell that set separately for 5,000. So this means what are the standalone selling prices? For that free set, 5,000 is the standalone selling price. And for the network service, for those 100 of free minutes, because without telephone set, you will be able to avail those 100 of free minutes by paying 1,750 rupees per month. So when I multiply 1,750 rupees with 12, so this means standalone selling price of network service is 21,000. So these are the standalone selling price. Handset 5,000 and network service is 21,000. So when I total it, So this means total standalone selling price is 26,000. Whereas you will be paying 2,000 into 12, mean you will be paying 24,000. Now I'll have to divide this 24,000 between the handset and the network service based on the standalone selling price. So what is the total standalone selling prices? What are the total standalone selling prices? That is 26,000, and 5,000 is the standalone selling price of the mobile set. So when I will calculate what is the proportion of the standalone selling price in the total selling price, this is 19.23%. This means I will be allocating 19.23% of 24,000 under this agreement to the handset. This will give me 461.
We are having our voice problem. Let me just order. Can you give me the mouse?
Yes, please. Can we say prayer at this point in time?
Just wait a moment.
We can have a Maghrib prayer break by the time
Sir,
if
we are not facing. So, can you people hear us right now? Can you guys hear us? I hope it is okay now. We are looking after your responses. Please tell us that if you can hear or not. I think they can hear us now.
so where from where should I start? At what point?
I think we missed out for quite seconds, or I think 1 minute or 2 minutes, not so long.
1 minute or 2 minutes?
Maybe.
Okay, I was discussing the
standalone transaction price.
Standalone transaction price. Okay. I was discussing the example. Members, I suppose we will be continuing this session till 7 o'clock, but I'm afraid that I will not be able to cover whatever we decided to cover during this session, because step 5 is still there and there are some examples related to step 5, and then transition provision, like what are the requirements and what are the flexibility available recently about the first time application that need to be discussed. That is very important. So we will continue this session tomorrow as well, and of course that will affect the portion of the consolidation, because tomorrow we have a plan to start the consolidation session, but we will utilize first half an hour or maximum up to 1 hour to cover the remaining portion of IFRS 15. So I again discuss with you. We were discussing like if you have how can you allocate the standalone selling prices. I gave you the example of our telecom company which is offering, like a customer has to pay 2,000 per month for 12 months. Mean customer has to pay 24,000 over a period of year, and the customer will be given a free handset and 100 of free minutes over for the whole year. And handset and the free of 100 minutes are two separate performance obligations. Why? Because that telecom company is also selling that handsets separately. And you can enter into this agreement without that handset. So both conditions are met. So handset and the 100 of free minutes, this is the service, network service, both are different performance obligations. Now, we shall be paying 24,000 over a period of 1 year. We need to allocate this 24,000 between handset and the network service. So first of all, we will see what are the standalone selling price. For handset, I told you if you buy it separately, you will have to pay 5,000 rupees. And for network services, if you do not opt for the handset, you will have to pay 1,750 rupees instead of 2,000 per month. So this will give you, when I multiply 1,750 into 12, this will give me the 21,000 network services standalone selling price and 5,000 free handset standalone selling price. Mean 21,000, 5,000, this is the total of the standalone selling prices. Now I will calculate the proportion of the handset standalone selling price within this total sum of the standalone selling prices. This will become like 5,000 divided by 26,000. This will give me 19.23%. So this is the standalone selling price proportion of the handset within the total of the standalone selling price. I will apply this 19.23% to the 24,000 to calculate the revenue to be allocated. I will show you. I'll show you from here. Like you can see that. Okay, just 1 minute. Okay, here you can see that from I was discussing with you this example. So from here you can see that this way you will be allocating. This is the standalone selling price of the handset. This is the network. This is their total. This is the percentage of the standalone selling price within the within this amount, and this is the 24,000 which we will receive. So 24,000, 19.23% of 24,000 is the revenue related to the handset, and 80.77% related to the network services. What will be the entry for this? The entry will be like because handset is being delivered immediately, so you will be debiting receivable immediately on 1st January 20x5 and crediting like revenue 4615. And then every month when you will receive the money, you will be reversing a part of the receivable which is related to this handset. So this is our step number 4. So before moving to step number 5, I would like to take your questions, because we have covered 2 steps without taking any question. So after Maghrib prayer break, we will be discussing your questions. So you can write your questions now.
All attendees are being requested to stay connected because we are having a small break. We have to do some things like prayer, and in the meantime, I remain connected with you because I have to look after your questions, chase up with them, and to help you out in your concepts that you will be uh, getting through the trainer. I hope you guys will remain with us. So stay tuned, and in the meantime, I request you to please forward your questions in the questions box, because the trainer will be answering to your queries after the break. So currently, all the attendees are requested to submit their question in the break time, and by the time the trainer will get back, he will be answering. In that time, while he will be answering to your questions, you guys cannot submit question, or maybe your questions will not be answered because we have right now around 460 attendees. So uh, answering to everyone will be difficult, as you can understand. So stay tuned. Thanks. We are having break right now, Zishan. Uh, the break is for about, I think, 2-3 minutes more from now onward. So please stay connected. We may be running our session after 7 p.m. for about 5 to 10 minutes more. I think it will be okay with all you guys. I hope you will understand today we have some kind of internet connectivity issue because in Pakistan you can understand the internet bandwidth is not good at some point in time. So I hope you guys will cooperate with us. Thank you. To all the attendees, there is another announcement. We will be sharing with you a Google Doc link from where you can download these handouts, including Word documents and the presentation is in the PDF format, so all the handouts will be available to you guys. Currently, I am processing on your handouts, uploading them, and soon after the end of session, you guys can download it from there. To all the attendees, this is, I think, an important announcement for you. So we will be sharing a Google Doc link with you in a very short time. Uh, all other handouts from our previous sessions are also available there. So you have to sort out the relevant folder. Uh, in each folder, uh, handouts are available, but to that very webinar. So I think my trainer is free now, so you guys can have the session with the trainer.
Yes, can you please read the questions which we have received?
Yes, we have some questions from our audience. Kindly elaborate more on the treatment of time value of money. I suppose if the contract includes cash selling price and also the consideration to be received adjusted for time value money. Time value, we will be recording the revenue with cash selling price only,
Yes.
and the time value factor will be charged as a finance cost or what?
Time factor, finance income, not charge.
Charge, okay.
Because this is receivable, and receivable is your asset. By unwinding, this will increase. So this will become your finance income.
Okay, people are asking, will the recordings be okay? I think for some point in time, the recordings might not be okay, but total recording will be okay and available to you guys. Okay, it is definitely a positive impression to say prayer as this is our religious duty. Okay, sorry, I guess miss the answer to my question, which is that how much relevant is IFRS 15 to insurance companies? Asked by Sayyid Rehan Jamal.
Sayyid Rehan, for insurance company, IFRS 4 and IFRS 17 are the relevant standards. If you just go back to, if you just go back to our earlier slide, if you just look at the scope, what we have here for IFRS 15, you will see that here you can see that this standard does not cover insurance contracts. I hope your question is answered. I hope your question is answered.
Under what name we recognize the liability relating to the revenue on the face of statement of financial position? Mohammed Asad Siddiqui.
Normally other tables, this will become a part of, not on the face of the balance sheet, of course, somewhere in the notes, and will become the part of other tables or something.
Fateh Fakhri saying, would you please explain the situation with construction companies at year end where there is a work in progress?
Okay, so what kind of explanation he needs for the construction company? Fateh, for construction companies, one aspect we shall be discussing, of course, tomorrow at the start of the session. Not at the start, once we finish with what we are discussing. That is, they have different types of contracts. Like some contract ends before, like 1st January 2018. Some contracts will continue even after this date. So how those contracts will be treated? How can we treat those contracts? Of course, this is part of our discussion, like from which date and how we will account for those contracts.
If an entity enters into a contract to sell a bulk quantity of unseasonal product with a potential customer, there is an unlimited relaxation of time to customer in terms of payment against those unseasonal product. That is, the customer will pay a minimal amount of payment against sold goods every week, and the total payment can take more than a year to receive by the entity. How should we recognize this transaction as per principles of IFRS 15? Is the time relaxation considered an addition promised to attract customer?
Relaxation of time. Relaxation of time is in fact cannot be taken as this will fall under because you have delivered the goods, and now customer will be paying you people are not very sure when he will be paying, but you can estimate the time, of course, time
I
value.
request you to repeat your answer because I think there is some kind of voice issue for a little bit.
Are we reaching now? Can you people hear me?
Yes.
No,
Yes.
this will be Simply time value of money. This is a financing concept, financing arrangement in fact. This is not a separate performance obligation. Next.
Okay, there is no more questions.
Okay.
In case of overstated checks against goods or services is not a proper question. Okay, no more questions are there.
Okay. So this was related to the last question. Now we can look at step number. If we take 10 minutes more, so we can cover that area as well.
We can take.
Can we take 10 minutes more?
Yes, people are saying yes. Sure.
Okay. So I'm leaving these three slides. These are quite straightforward. Repurchase agreements. So there could be transactions like you sold an asset or sold goods, an asset, and that will be repurchased, and there could be different situations in repurchase. So what will be the treatment for that? Very simple criteria, and this concept is explained with the help of this example. Okay. Now step number 5. Step number 5 is that should you recognize that revenue at a point in time or over the time? At a point in time or over the time? An asset is transferred when or as the customer obtains control of that asset. When a customer obtains control of that asset, you can say, like for example, using the asset to produce goods or services, he started using that asset. He started using the asset to enhance the value of other assets, or he started using the asset to settle liabilities or reduce expenses, selling or exchanging asset, pledging the asset to secure a loan, or holding the asset. For example, when evaluating whether a customer obtains control of an asset, an entity shall consider any agreement to repurchase the asset. So this is the control. You will have to reconsider the control. Now, our main point is, if asset is being controlled by the client, so how the transaction price should be recognized? Should it be at a point in time or over a period of time? See, if it meets one of the following criteria, then it will be recognized over a period of time. What it says? It says a performance obligation is satisfied at a point in time unless it meets one of the following criteria, in which case it is deemed to be satisfied over time. Any of the following 3 criteria. Number 1, customer simultaneously receives and consumes the benefits provided by the entity. Now I think now it is 7 o'clock. Increasing this time by 10 minutes will not help, because this way we shall be covering this very important concept very quickly, and this will not serve the purpose, because this is not the only step which we are going to discuss with the help of examples, but we have a couple of other concepts as well. So thank you very much for joining this session, and I hope we will continue.
We received some questions. I think
yes, we can answer some questions by that time, but we will continue this session tomorrow as well, and we will take maybe half an hour or 1 hour. Then we continue. Then we will continue with the consolidation session. So of course your CPD hours will be considered accordingly. Whosoever attended this session as well as a small portion of tomorrow's session, that both will be collectively taken as a session for IFRS 15, and thereafter consolidation session will start. Yes.
Sir, can you please share the material one day before starting sessions so that we can read and make questionnaires? I think this would be more helpful. Mohammed Sadiq.
Muhammad Sadiq, I will consider it. I will see what can I do in this regard.
Okay. When will you provide the session on insurance contract accounting standard?
No, it is not yet planned. I think it is better, should be asked to our ACCA team, Mr. Harun Jan.
Please repeat the two criteria to identify whether the goods and services are distinct or not, both individually and in respect of the underlying contract.
Muhammad Asjad, see, normally if there are apparently more than one good or service, this criteria normally meets. The problem is to identify whether the goods or services are distinct in the context of the contract or not. Because for the first part, is the goods or services are distinct, very simply see, does these goods or services do they sell it separately? If they sell it separately, then these are distinct. Or if they are not interdependent, mean promise to deliver one good is not dependent on the promise to deliver another good, then they are like distinct. So first criteria normally meets, or if they can function independently with the other readily available resources. So this is the first condition. Second is, are they distinct in the context of the contract? So in order to, so three things should not be there. There should not be significant integration of one good with another or one good with the service. There should not be significant customization or modification. And there should not be significant interdependence. When we looked at the hospital example, the agreement was for a combined output of hospital. And for the construction of that hospital, there are various services which was being provided: engineering, piping, construction, foundation. Many services were involved, and you can take them as a distinct as well. I mean, first condition was there. I mean, there were many distinct services within that hospital contract. But when we look that contract, we find that all services need to be significantly integrated to provide a combined output of hospital. So second condition, because of significant integration, is not met.
Again, voice is on for
So that's why Fikran Mukammal Khan.
No audio, no sound.
So we can continue tomorrow with these questions as well.
That would be. So guys, can you hear us?
Okay, Wes, I don't know where I was not reaching you, but anyway, that was the combined output, in fact. So second condition is not.
Muted.
That's why both conditions must match.
Unmuted.
Hospital, building of hospital is a single performance obligation. Other question?
Burhan has been asking again that his question should be answered. If an entity enters into a contract to sell a bulk quantity of unseasonal products with a potential customer, there is an unlimited relaxation of time to customer in terms of payment against those unseasonal products. That is, the customer will pay a minimal amount of payment against sold goods every week, and the total payment can take more than a year to receive by the entity. How should we recognize this transaction as per principles of IFRS 15?
Burhan, we were not reaching at that time when I answered this question.
We were reaching at that time, but for quite some time we lost. But again, you have answered to that question. But I think
I don't know,
Burhan
Burhan,
was unable to,
we can take up this question tomorrow session.
or he can send this question to your email as
through
well.
email. Then I will be taking up your question in the start of tomorrow's session. We can run a feedback.
Sir, can we share the Google Doc link with?
Yes.
And how many handouts you want me to upload there? All the handouts or a few of them? Currently, I have uploaded 3 handouts, including our presentation and example 10 and example 11.
Can you please share this link?
Okay, this link is also in your presentation at the last slide.
Okay. Okay.
Last slide. Yeah, this one, last one, yes. So guys, here is the link, Google Doc link for your handouts. Currently, I have uploaded few of them, and after the permission I will be receiving from our trainer, I will upload all other remaining handouts. So I think the remaining handouts will be available to you in further 10 to 12 minutes.
You can send them out, no problem. You can send them out, no problem.
Okay, the presenter has allowed me, so the remaining handouts will be available to you in a short while. Thank you so much.
Pop up for the feedback. Meanwhile, pop up for the feedback.
Please give us your feedback in respect of our today's session. Currently, we don't have any poll in respect of feedback.
You can create one.
You can comment us in the question box or in the chat box. Please tell us about today's session. If this is exceptional, excellent, good, very useful. Okay, people are saying Dishantur is saying good.
Thank you,
Mohammed
Zishan.
Aziz Siddiqui, very useful.
Thank you. Zishan Asif, thank you very much.
Please participate. Shakil Zulfikar, useful, excellent.
Thank you. Thank you very
Useful,
much.
good, useful, Talha Farooq, very useful, excellent.
Thank you.
Thanks to all of them.
Thank you very much for your feedback. And from my side, Allah Hafiz. Thank you very much.
So guys, just take a sigh. I will be uploading the remaining handouts. This will be available to you by 7:15 p.m. Pakistan Standard Time. I hope you guys will download your handouts from there. Thank you. Thank you. Allah Hafiz. Goodbye.